Hey everyone, welcome back to the Chain Reaction Podcast. I'm your host, Tom Shaughnessy, a co-founder at Delphi Digital, where we're 5 full-time analysts focused on institutional crypto research. If you aren't a subscriber, you're missing out, so visit the site while you're listening. One quick housekeeping item. This podcast is strictly informational and educational and is not investment advice or solicitation to buy or sell any tokens or securities or to make any financial decisions. I may personally own tokens that are mentioned on the podcast, and you can view the show notes for our full disclosures. Hey everyone, welcome back to the podcast. Today we're back with another discussion following our episode with Ryan Hasu. We now have on Harry Sudock, the Director of Strategy at Griid Infrastructure, and Nick Sandomeno, who's a wealth management advisor. Harry, let's get started with you. Give your background.
Sounds good. Thanks for having me on, Tom. I started to get obsessed with Bitcoin in late 2016. That only grew to the point where I knew that I had to enter the space, somehow full time. That started by, some independent consulting work, working with, hedge fund clients in the US and Asia. And then at the end of 2018, agreed to join Griid Infrastructure as the Director of Strategy, working on all things supply chain, hedging, and really growing the team from the ground up as the first employee.
So that has to do totally with Bitcoin mining, correct?
Yes. So we are a fully dedicated, vertically integrated Bitcoin mining operation. We searched the planet for attractive energy locations, and we plug in as many ASICs in as aggressively as we can. That's interesting. And Nick, give us your background.
Yep. So like Tom said, I'm a wealth management advisor working for the Astorino Financial Group, a wealth management firm in Northern Jersey. We offer securities through LPL. It is the largest independent broker-dealer in the United States with over $706 billion in advisory and brokerage assets currently. So my field is still something where crypto is kind of a gray area. But I think all of us would agree that crypto is creeping its way into the fiduciary obligation. So initially, I was not very interested in Bitcoin. I thought it was a cool technology. I'd admit to falling under the blockchain, not Bitcoin category for a while. But that changed as I started to understand the accounting of the Federal Reserve System. And in my opinion, quantitative easing gave this a chance to really flourish. So I kind of backward engineered my way into the crypto rabbit hole, and that this is not something that is, or at least initially was thriving on its own, but more of, if you think about it from the exchange rate perspective, this is a lot of fiat devaluation when you look at market cap. And I think from that perspective, price is more important than some let on. But with my employment, I do have to give the disclosure that nothing you're going to hear from me today should constitute investment advice. But we're going to get under the hood here.
Yeah, couldn't agree more. And I love the questions you pose on Twitter, Nick. They're definitely thought-provoking. And the discussion or the center of gravity for this episode is going to be the sustainability of Bitcoin's security model. So that goes back to miners. It goes back to hardware, costs, and profits. So we have to get into all of that. So I guess, Harry, let's start with you here. You're basically in the weeds running, a Bitcoin mining company. So how do you think about the costs and revenues of mining through Bitcoin's 10-year history to today?
Yeah, so I think the historical component is critically important. When Satoshi Nakamoto dropped the white paper, it was one computer, one vote. And over a long period of time, they had an opportunity to mine quietly in seclusion. Dan Held has covered a lot of this in his 4-part series around launching Bitcoin. And this type of, fair open source process around the advent of this asset is really where we all kind of need to start. So an individual running a computer, running code is what constituted Bitcoin mining as of 10 years ago. Fast forward, things have changed dramatically, where the manufacturing of ASICs, which, for those who don't know, are really dedicated computers that only perform the Bitcoin hashing algorithm. Other hashing algorithms are used for other machines, but for the sake of this discussion, and a Bitcoin ASIC is the dedicated computer that contributes the hash to the network, and all economically viable mining is now done with those types of machines. Being able to contribute, your laptop's computing power to the network while, courageous and heroic is astronomically unlikely to earn you a block reward, for instance. So the professionalization and the industrialization of the industry has moved towards these dedicated manufactured chips. Folks you've heard of are Bitmain, WhatsMiner, InnoSilicon. These are the major manufacturers in the space today. So because of that, the need for professionalization in mining has come about. And that means sourcing really significant large amounts of as cheap energy as you can get your hands on to run these computers. They are highly energy dense. For instance, we're in the process of launching one of our sites here, and the energy for that is going to be the equivalent of 3 Walmarts. We can get into the ethics of energy consumption at a different date. I fall firmly into the camp that Bitcoin is great for the environment. But just to give you a sense of scale, these are incredibly energy dense operations that are happening and therefore require high quality electrical engineers, high quality network engineers. There's a really significant skill level that's required to operate a facility of this nature.
Yeah, it's obvious that we went from, hobbyists running the code on their laptops to basically full-scale data centers with entire staffs to run them with specialized equipment. It's pretty interesting that we've gone through that, entire dynamic within the last 10 years. I mean, Nick, you're obviously seeing the same thing on your end, or do you have any, problems with how things have played out during the growth of mining?
No, not at all. I think that even if it did differ from what was originally set out to be maybe more of a hobbyist activity, and it has clearly evolved into something that is an industrial scale. But I think that's actually really important for the kind of trust that needs to be built up in a system like this. And I think many of us would agree that the kind of power and all these mining rigs that are supporting the day-to-day, the every 10 minutes a new block comes out, that is going to catch on with it being an industry compared to a hobby. So something that Harry mentioned that is pretty interesting to me is that Bitcoin is good for the environment. And I think that's a really interesting perspective, and maybe even out of consensus within the crypto community as a whole right now. And you see that kind of proof of stake. I think it's fair to say that the initial motivation for that was to address crypto becoming something that is harmful for the environment. And today, I think it's only about 0.06% of total energy consumption in the world. So that's it is something that, because mining relies on cheap electricity costs, it's going to be driving the ball forward with implementing renewable sources of energy production. So it's one of those things where maybe it's not worth bringing it down, and that we kind of need what I like to call a lawnmower solution to environmentalism compared to what we're doing now, which by getting rid of Bitcoin or using paper straws feels more like you're trying to maintain your lawn by picking all the grass. So it is a large and increasingly larger industry that wants this renewable energy implemented as well. And I think the issue with that right now is that renewable might not mean cost effective right now, but Harry, maybe you could shed some more light on the trend towards renewable and what that means for your profit margins in the mining industry.
Yeah, Harry, I'm definitely interested there. I mean, so basically what you guys are saying is that since Bitcoin's mining has evolved from, hobbyists to full-scale data centers, the need for massive amounts of electricity is pretty obvious. If I had to take the devil's advocate view, just for the sake of the podcast, I think that 0.5% of the world's energy is pretty insane. But at the end of the day, it's a free market and everybody should be able to use electric however they want. Harry, how do you think about sustainability, massive electric usage, and searching for renewables?
Absolutely. The perspective that I try to approach it from, and let me ground it in the Bitcoin security model again for everyone. One of the attack vectors against long-term proof-of-work sustainability is if folks had energy usage regulated out of existence in a large multi-government coordinated attack, right? If China came to the table, Canada came to the table, US came to the table, Iceland came to the table, and among others, and said, Bitcoin mining usage dead, and used their jackboots to step on the throats of folks who were doing what we're doing today. That's one attack vector that we need to consider as we look at the long-term viability, sustainable model of the security. To address more specifically how the energy is actually getting consumed, you're absolutely right, Tom, that 0.5% is a ton of energy. But the assumption within that I would challenge right away is that not all energy is created equal. We can all agree that me running a nuclear reactor and you running a coal power plant have wildly different implications from an environmental perspective. That's a no-brainer. So if we look at the distribution of what energy is a good, quote unquote, a good fit for Bitcoin mining, which, says to me that it's cheap being the first and foremost driver, I look at things like solar, like wind, like flared off methane, like nuclear, and like hydro. Those are the kind of the big five to me that are immediate great fits for Bitcoin because they all have a virtuous cycle built into them with regard to high use time periods and low use time periods. So if you think about a grid, no pun intended with the company name, or GRIID, not one I, then the way you need to think about it is let's just take, New York City is a high density area. During the middle of the day, when everybody is in their office building, those buildings are going to be using dramatically more power because all of the lights are turned on. When everybody goes home at the end of their commute by, 6, 7, 8 o'clock at night, the energy usage in the city goes down. So the quirk there is that the production of the energy doesn't cycle the same way that the consumption of the energy does. So if you look at something like solar, it's borderline use it or lose it. If I'm able to attach an ASIC to the back of my solar panel, it's use it all the time because it's economically productive and I don't need to make the additional investment in attaching my solar panel to more than just my house and my ASIC. I don't need to attach it to the grid to try to sell it back to Duke Energy because I've entered into some kind of agreement that marginalizes me as the small user. Same thing goes for wind. It's a question of the capex related to connectivity for those two specific types of renewable solutions. All I need to do is connect my wind production to my locations of consumption, being my house and my ASIC. Maybe a battery if I want to have some nominal level of backup, but a diesel generator is still better for that. Then you got to look at the use case of methane flare. There's massive amounts of methane flared off all over Canada and Texas all the time. There are environmental mandates that gets flared off for a limited amount of time. If instead of, burning and just, to get into the weeds, instead of burning it off, you can plug in that flare off to a generator and run ASICs off of it. So you're taking something that's a massive environmental negative, being the methane flare, and turning it into a positive by making it economically productive. There are, oil and gas companies who will pay you to do that instead of making you pay for the energy. Then you've got to look at the two, what I think are probably the two most important ones, being nuclear and hydro. If I don't use the water that's sitting behind the dam and I let it flow over the top, it's potential energy being converted into mechanical energy through the movement. I could just run that through a generator. There's all sorts of hydro that the investment hasn't been made to connect that hydro generator to the larger grid so that it can be used on grid in houses or other industrial locations. What this does is it creates a solution for the energy producers of the world to have a more localized revenue positive solution so that less of this that isn't always in use gets consumed somehow and doesn't go to waste. And nuclear, the same thing. These are opportunities to further incentivize building these massive plants, and all of a sudden they've got a more reliable customer in their network to create a second revenue stream other than just me running my air conditioner in the summer.
Yeah, that's super interesting, Harry. And just so that people are aware, I'll probably bring this up a lot, but the whole basis of the conversation is the sustainability or the growth of Bitcoin's mining ecosystem for the security of the network, so increase the hash rate. And Harry, it's really interesting you bring up that we should be looking at renewables and electricity usage, not on an absolute basis where Bitcoin is using, say, 0.5%, but that it's using sustainable sources. Do you think we'll ever get to a point where people start quoting Bitcoin's not using 0.5% of electric, but say Bitcoin is using 25% of the renewable electric produced around the world? Like, I'm wondering if the framing of 0.5% energy is just incorrect.
Yeah. So the way we look at energy is wholesale wrong. So not, I'll say it again, not all energy is created equal. So I think that Bitcoin plays a massive positive economic driving force within the renewable space. And, I want to be really nuanced here and say not only within just renewables are the best because they're the cheapest. The problem is they're hard to build at scale and they're hard to connect to the larger energy grid. Like that's the fundamental problem. So what Bitcoin does is it removes some of that need for that connectivity. So I really do agree with what you said, that Bitcoin will be the use case for an ever-growing percentage of renewables. I think it's also a difficult thing to measure because I think renewables will also grow to be a larger percentage of overall energy production. So I don't know which will happen faster. But I think it is really safe to say that you need to quote Bitcoin mining energy consumption in terms of its share of renewables.
Yeah, for sure. And Nick, what are your quick thoughts here on the sustainability of Bitcoin's mining linked to renewable sources of energy?
Right. So there's already in the US alone, based on wind and solar, there's enough wind and solar, both renewable sources, to power entire Bitcoin electricity consumption at, I think the estimate there is just over 100 terawatt hours a year. So that's just from the United States alone there. So like Harry said, to connect it, and this is not a crowding out effect of other things. It's kind of a source of energy that may not otherwise get used, to put a little bit more simply. So it's making, again, it's just driving the incentive to keep the ball rolling here and making renewables more prominent, because the increased costs of switching from less environmentally friendly sources of electricity. There's that buffer because of the economics where it's not yet justified. Renewables being 100% is not justified. So what is something that can kind of ease that cost is knowing that you have something new here to kind of suck up or amortize the cost.
Got it. And so I guess if we're thinking about renewable sources, these aren't things that are cheap, right? So 10 years ago, hobbyists just ran software on their laptop, but now we're talking about building entire, solar panel fields or, potentially nuclear reactors to power Bitcoin mining. It seems like those costs, if we extrapolate this out, are just going to be enormous for an individual. Harry, do you think about these growing costs as a centralization factor? Like if only, 20 people could afford to build a nuclear facility to mine Bitcoin, isn't that an issue?
Yeah, I think energy density is simultaneously a centralizing force and a decentralizing force. So from the standpoint that, how many people on Earth can build, hydro dams at scale, how many people on Earth can build nuclear reactors at scale, you're right that would be a centralizing force, but there's also a very natural decentralizing force within energy distribution for the Bitcoin network, where at most, maybe I'm able to get a few hundred megawatts out of a dam at most. And so on a percentage basis, I don't know of any hydro dams that are fully operational today that represent even 10% of the Bitcoin network. You look at pools, there are immediately pools that are over 10% today. So I think that on a relative basis, the energy density distribution around the world is a decentralizing factor.
That's helpful. Nick, how do you think about that point?
Yeah, no, I agree. This is much more Harry's wheelhouse here, but it's once you get past the tipping point where renewables are over 50% of generation, and I think for electricity alone, the estimate given by the U.S. Energy Information Administration is that by almost 2040, 50% or close to 50% of electricity generation is renewable. So getting to that point, it might be centralizing at first, but I think in the long run, it ends up being decentralizing.
That's helpful. And Harry, to your earlier point, this might be, basic, but how much electric is actually 1 megawatt? Like when you talk in electricity for these mining farms, like how much electricity actually is that?
Yeah. So basically 1 megawatt, I like to think about things in terms of just like you've seen like a Bitmain S9 unit, for instance.
Of course.
A megawatt is roughly 700 of those.
All right, cool. So the sustainability discussion is interesting. I mean, to move forward and to switch gears a little bit, I think we should talk about how Bitcoin, kind of relies on continuous price appreciation for the sustainability of a security model. And if you guys agree or disagree with here, I guess, Nick, we could start with you here because you brought up this point. How do you think about this and what's your main takeaway there?
Well, I think there's your natural source of transactions where you see that over the history of Bitcoin, just looking on a log scale of price, that transaction volume and price are correlated. And I think a way to think of that is that miners who are accumulating more of this than anybody by the Coinbase reward, they need to find a price where they feel comfortable kind of letting go. And maybe that transaction volume tick up when the price ticks up is because of that. But obviously what you want to get at is more of these micro payments, something that the Lightning Network is focusing on, where you're getting more scale than size. And there's a balance between the cost of a transaction, which contributes to miner revenue, versus scale, and just working on creating a base of transaction volume and transactional demand to inevitably make that enough of a reward to keep miners there when there is no more Coinbase reward. So I think the first question is, can you get there organically just by the Bitcoin network alone and transacting on-chain Bitcoin? So I think, and again, Dan Held's done a tremendous amount of work in trying to justify that, but you do come back to this market cap assumption and annual mining revenue as a percentage of market cap. That's what needs to be maintained. So we look at that now, and it's a combination of the reward of new supply and transaction revenue. So we need to get to that switching point, and there are things that can drive transactional demand that is not, maybe relates to the network a little bit more indirectly. And I think something that Nick Carter put forth is the idea of semantic density, where other applications, other blockchains are leveraging the hash power of Bitcoin for security, essentially. So you have potentially new sources of transactional demand are supporting this. So I think there's a number of ways to looking at it. First, I think you start with how far can organic on-chain transactions take us, and then you start to consider some of these other developments that are going to make that look differently than we view it today.
Excellent. And I realize we, pivoted somewhat quick, but what Nick's alluding to is the argument or the discussion around when Bitcoin's block rewards and the fee market, what you have to pay to send a transaction, has to take over that difference to ensure the security of the model, because we have to pay miners either through block rewards or fees. Harry, how do you think about this? Because Nick gave a great overview and some great detail, but you're in the midst of mining. I mean, I know this is a ways out, but are you afraid of what could happen if we have to switch over to transaction fees only?
The answer is that it's always the right thing to talk about this stuff, especially in Bitcoin. We do as a community a great job of surfacing risk and surfacing discussions about risk. So, anytime we have an opportunity to think far ahead and look at edge cases, that's the right thing to be doing. The anecdote I've always heard about entrepreneurship is, it's like jumping out of an airplane and trying to build your own airplane before you hit the ground. So I do think that Bitcoin is still an experiment. We are still early. This is still a very large, very expensive experiment that we're all engaged in and grateful to be doing so. In that vein, I would also try to ground us in a couple of the concepts around the Schelling points in Bitcoin. The first and foremost, most important one is that there are 21 million units, and that is all. So if we are going to organize as a network around that Schelling point, one of the requirements for it is that eventually the inflation rate goes to zero, or the distribution rate goes to zero. So to abide by that Schelling point, which I think is the most important piece of Bitcoin, we need to be grounded in that fact. The second piece of the Schelling point discussion is that we've achieved social consensus around a UTXO set. So that means that, the three of us and everybody engaged in the Bitcoin network agrees that the most current, unspent transaction universe is right. And that means that miners have secured it. That means that we have proven from the beginning of the chain and that there have been, an adequate, number of decentralized full nodes validating the chain, that who's got what is secure and makes sense. So really what Bitcoin is it's a mechanism to organize social consensus. The social consensus in this case is the current unspent transaction set and the 21 million eventual hard cap. The assumption that arises from that grounding is that we are in an environment where block space is competitive. So we think about the 21 million fixed cap. We also need to think about a truly scarce commodity in the form of block space. Because we can agree via the social consensus that's organized by the software that block space is a scarce commodity, there will be upwards fee pressure so long as adoption rises. And I would challenge Nick a little bit with some nuance that adoption doesn't only mean price appreciation. I agree with him that price appreciation and transaction volume are correlated. But again, I would assume really that adoption is going to look a lot more like an S curve, whereas overall market cap is going to look a lot more like an asymptote towards the upper bound being global wealth.
Nick, how would you respond to Harry's point there?
No, I can definitely agree with that. I mean, should the S curve kind of play out, I agree that that's more likely the case. But in the meantime, until we get to the kind of the tapering out or kind of a level state, then I think something that also comes in is like the Gini coefficient, where this is the people who are holding Bitcoin right now are viewing it differently than the people who are buying it in a run up like 2017. So there is kind of a dense core, what a lot of people call the hodler base, is the consensus there is not to transact, right? This is a store of value. This is something that I'm incentivized by its disinflationary properties to hold on to for the long run. So for those people, the ones with the most conviction to let go, they need to see some kind of price where it makes sense for them to kind of further distribute Bitcoin into people. Maybe it's too general to say, but with less conviction, who might actually participate more in transactional demand and use it more so as a medium of exchange than a hodler base would. So we need to see what I referred to before as semantic density, or even something a little bit different would be microtransactions enabled by Lightning Network, which basically just touches base with the Bitcoin blockchain every so often to kind of increase throughput and settlement time. So it will take time to get to that point, but my earlier comment kind of was more on how do we get there? And I think that correlation plays out more definitely in the short run than the long run.
For sure. And Harry, to your point, I mean, we speak to people on Wall Street or legacy traditional finance, folks. Basically, we bring up the Schelling points, but at the end of the day, and for sake of construing it, I mean, if Bitcoin goes over 21 million, it's obviously not Bitcoin, but I think it's worth saying that it's definitely not a solved thing that the fee market will overtake block rewards. Is that fair?
We have not seen it happen in the wild yet, and therefore I think it's fair. So this is a reasonable line of discussion. I'll preface this with that and say, I do not feel totally certain that the fee market will overtake the block reward, or at least supplement a large enough percentage of it to, create adequate security. And, we've brought up Nick Carter a couple times, who's one of the, the absolute apex predator within the apex predator money. In a presentation that he gave, he bucketed out security into three mental models. One of them is stock. So what percentage of market cap needs to be generated by the fee market flow, what percentage of transactions need to be represented by fees. But the third one that goes under discussed that I think we're really hitting on is this concept of threshold. So we can all agree that we need more fees than we have today, but how many fees are enough fees to create an adequately secure Bitcoin? That to me is the biggest question mark. And until we know how much is enough, it's really hard to say, this will be the path to adoption. This will be the path to more fees. I do think that, in addition to price appreciation, because I really do think price appreciation is a critically core driver. And, if Bitcoin's going to work, massive price appreciation will have to follow. And I mean price appreciation in terms of purchasing power, because who knows what currency, this thing's not going to eat. I just want to add, the last piece of it, which is that we find ourselves in an ever increasingly strange global environment. And I don't want to undersell the necessity factor of Bitcoin in different areas. And I'm not going to bring up kind of your traditional hyperinflation, Venezuela thought piece, but I am going to say that, if you're someone who's living under significant authoritarian rule, and I think that list is longer than we think, you need this, or you might need this really soon to get your wealth out of the environment that you're in. Asset forfeiture and asset seizure is very, very, very real, as are negative interest rates on savings accounts. It's coming. This is going to happen. We look to places, like China and like the Hong Kong protests, but we also look to what Deutsche Bank is doing, saying we're going to give you negative 75 bips. These are not environments where you want to have your wealth stored on a trusted third party, because those trusted third parties are volatile and they are oppositional in many, many cases. And they haven't, reared their heads recently, but that doesn't mean that they won't happen and won't happen quickly.
Yeah, I couldn't agree more. I mean, there's 17 trillion in negative yielding debt, I think. And I think when most people, especially from the US, travel abroad, they go to, a developed country and they don't realize the necessity of Bitcoin in underdeveloped countries, or countries where they're basically taking advantage of their citizens, hyperinflation, take your pick there. So I definitely hear your point. Nick, on the fee market, I have a question for you, because I know you think a lot about other protocols in the space. If we had to really focus in, and let's say that a viral fee market is necessary for the sustainability of Bitcoin or a competing platform, and that's the world we're in, decades from now, do you think that other layer ones that, that are more expressive, that can, more things can be built on them? So in essence, there's more opportunity for fees to be paid down the line. Say a viral Facebook is built on a new layer one, which drive transaction fees. Do you think that's a risk to Bitcoin's sustainability there in developing a fee market?
I think it creates a balance. But so in other words, that if it gets too high, yes, that's going to overflow into other layer one protocols. But I think that something that's important to mention there is not so much, it's the social or philosophical idea of what the Bitcoin blockchain represents, and why that, even given a more superior technology that can satisfy kind of that hard money property, as well as a low cost to transact. First of all, that sounds kind of hard to achieve, right? Something that's really what we'd call sound money. And so in other words, doesn't cost a lot to use it, but it satisfies hard money properties. That seems kind of out there to me. So I think that's something that it would have to be a developmental shift in Bitcoin. In other words, you hear a lot about increasing block size, but I think it would take something like decreasing block size to really make that spillover effect into other layer ones so great that it actually takes away. So it is the specialization of the equipment that's coming into play that makes Bitcoin more secure than others. And it's just looking at market cap alone, I think it's far off from even Ethereum, which is widely deemed as very secure. So there's a huge gap there, and it's because of that, in my opinion, that trust essentially. So no, I don't think there would be other protocols nipping away because they can simply offer lower fees. Because to me, that's just the polar opposite of the scarcity that comes with Bitcoin. But I think some of the things that can kind of push that and say, hey, we do need this to be more expensive. We feel it's justified based on the industry that has come to secure this, is things like elements from Blockstream, a sidechain project, and Liquid, something that has directly stemmed from that, allowing or increasing transactional demand and also satisfying what traditional finance or Wall Street would like to get out of blockchain, and that Bitcoin not blockchain not Bitcoin mentality. And that something like Liquid, which is an inter-exchange settlement layer that kind of suspends Bitcoin on the main chain and allows it to trade with more privacy and quicker settlement outside the main chain. That's a way to kind of push how valuable can we make the space within a block. And again, we're talking about it not being enough to sustain. So I think things like that are going to help to get it to where we need it to be in terms of mining revenue from transactions. But I think it would be too much to say that that creates such demand to get in the next block that it creates a demand that is ultimately threatening to Bitcoin and other layer ones.
Got it. I mean, just to make my question more specific and pointed, though, I mean, and Harry, we'll go to you and Nick, that was extremely helpful. But Harry, just to get your thoughts here, let's say we're in the future, we have two protocols, and one is Bitcoin, one is a competing layer one. You know, take your pick. There's 20 new layer ones launched over the next 2 years. We have a post on this we're working on. But let's argue that you have to compete for a viral transaction fee market for the security of the miners. Let's say Bitcoin obviously isn't as expressive, but it's obviously the dominant store of value here. No qualms there. But let's say that you have a competing layer one that's more expressive, so real projects can be built on top that could drive massive use and a ton of transaction fees. Do you think that might then compete with Bitcoin for higher security because a competing layer one is more expressive? I know it's a very specific question, but I think we should talk about the drivers for transaction fees moving forward.
I think that the level of scale that an expressive layer one would need to get to. So I guess the question that I would have is, how do you suggest that this alternate layer one achieves meaningful enough market cap to be compared to Bitcoin?
I guess I would push back in that it wouldn't be a question of market cap. It would just be a question of what's built on top, driving fees to the bottom. And if that's more competitive than Bitcoin, is the security then greater? And is this a risk?
So I think that what's baked into what you're saying is really, there's a good graph about it that I wish I remembered to share to you guys. There's this wide but shallow, or skinny but deep comparison between two different types of fee markets, right? Where the average fee percentage, let's just say that it's a $1 fee on this other layer, and we'll use dollars, but you need to generate 50 million transactions, whereas on Bitcoin you have $1,000 fees, but you only need to generate the same proportion, a much smaller proportion of transactions. The argument really is, how do you find the balance between fee percentage and number of fees? And that kind of brings us full circle back to the protocol valuation argument. If there's a protocol that's costly from a fee perspective, but they've generated virality, I'd be really, really surprised that you're able to accomplish both those things. Because if you have a high fee percentage, but a low network value, the justification for moving those coins is very small.
Yeah, so I think, to very simply put, what we're talking about is there's an inherent trade-off between security of transacting on one layer one versus another, and the cost associated to do so. So something you touched on earlier, Harry, that might eventually lead to, Tom, what you just asked me about can there be a spillover, or can something else threaten Bitcoin as it becomes increasingly more dependent on transactional demand? Is when we find out what this threshold is, or the minimum amount of security that can keep a network running, maybe that plays out in a much more strong way. So in other words, that if it's the security that is driving the cost of transacting on one layer one versus another, and the level of security on that layer one is way above the threshold, and again, that assumes that we have a much better idea of what that threshold is, and maybe someone can much more clearly make the decision, well, if the trade-off is between security and cost, and all these are way above threshold, then I'm going to go cost every time until we feel out what that kind of floor of security is. Does that make sense?
Yeah, I guess it does. And switching gears a little bit to hit on a different point, I mean, a lot of Bitcoiners in the space and people in crypto kind of argue, we just want more mining equipment. We just want higher hash rate. And I agree with that. Like, you want a more secure network. But Harry, what you're describing earlier on, the fee market in the future, I mean, I feel like we'll get to a logical point where we have X amount of fees. This supports X amount of mining equipment at some price. Do you think we'll eventually reach some type of equilibrium on hash rate and amount of nodes out there, or is it just more the better?
Again, not all hash rate is created equal. So the distribution of who is hashing and where they are hashing all matter. So what I don't want to suggest is that if we were to say Xi Jinping should control, another 50% increase in hash rate, I don't feel great about that. So there's a tension between increased hash rate and increased centralization. So long as the hash rate that is coming online is either economically or idealistically motivated and it's sufficiently distributed, I think the more the better.
That's helpful. And I have a couple rapid fire type questions for you guys before we get back into the mist, but feel free to answer quickly or take your time, however you feel, but just some more thought-provoking questions. What if a government deployed $100 billion, trillion, even if they're able to, in mining equipment now or in the future to basically mine Bitcoin? Do you see this as a risk, helpful? Is this a concern you guys think about? I guess, Nick, we'll start with you, and then Harry, jump in.
Yeah, definitely. So I think it would be, are they deploying that purely to ultimately destroy the network somehow or just dominate? And if so, I think that we have now a precedent, given kind of the user-activated soft fork or New York agreement that occurred around segregated witness, that nodes and holders do play a role here, and that they can reject potential mining revenue. That was a situation that we saw, and it's something that led to my confidence building up and Bitcoin specifically. So I think that even if that were to play out and the motives were destructive, that there are ways that other participants in the network can check that or mitigate it. And I think it's still leaving it to up to determination really on how that would come about. But it would be like a creative solution to say, maybe maybe that creates some kind of a fork, or we're not going to recognize the participation of this hash power, but there are ways for other participants to ultimately check that.
Harry, what's your take?
Yeah, I think I'll make two quick arguments. One, it would be profoundly difficult for a government to do that. Building mining operations is really, really hard. So I would question their technical and logistical ability to accumulate enough ASICs to acquire the necessary energy resources dedicated to it, to actually build and stand up the operation, and then to maintain it on an ongoing basis. That's all really hard at the scale that you're describing. It's hard at a smaller scale, but it's really hard at the scale you're describing. And then second, exactly what Nick said. The Schelling points that I believe govern us all are the 21 million hard cap and social consensus UTXO set. If the UTXO set moves out of social consensus, there is These are drastic measures, but there are opportunities for the network to return to a UTXO set that is still within consensus if it moves out of consensus based on an actor like the government that you're describing.
Yeah, it would definitely be too hard for a government to basically accumulate that much money and expertise in a short amount of time. Just something to think about. And then I guess another one, and this is probably, people are going to hate me for even thinking about it, but let's say Bitcoin's price is moving down into the halving. So we kind of have two issues here, right? How do you think the market would react to that? Or am I just, dumb for bringing that up?
No, I'll run with this. You're not dumb for bringing it up. We didn't see it in relation to a halving, but we saw that when the price crashed from 20K to 3,200, we saw a decrease in hash rate. Not everybody has the same cost of electricity. So what you would see is a reduction in hash rate because people with high cost electricity would have to shut down their operation. And there would be a migration of ASICs from high power cost miners to lower power cost miners, bringing the mining industry back into net profitability once those disadvantaged folks had been shaken out. It would all be normal. Everything would be fine.
Makes sense. Nick, what do you think?
Yeah, I agree with that for the most part. And I think that fear, that question is even coming from is there a downward spiral effect where price drops below a profitable level for miners go offline, price goes lower, and then there's just this downward trap almost. And I think Harry answered that better than I could, but I don't think it's a concern per se because it balances itself out in that way.
This is the elegant solution. But Bitcoin is the elegant solution because it has created so many inherent virtuous cycles. The incentives are so beautifully designed that these types of risk factors are, if not eliminated, massively mitigated, simply through beautiful design decisions.
I couldn't agree more. And Harry, I have one longer question for you, and then Nick, one longer question for you on the Bitcoin dilemma. But Harry, we'll start with you because it's specific to what you do. Could you walk us through how hard it is to basically get a mining facility up and running? I mean, just attracting the capital, deploying it, the ongoing expertise. I'm waiting for the day that Blackstone and KKR get involved here. Maybe they already are, but I'd love to hear it from you because you're basically there.
Yeah, so I'll walk you through kind of the back to front. But if Blackstone or KKR, want to talk about how to, dramatically accelerate our scaling process, I invite them to, email me or give me a call, because we basically have a power pipeline that we probably couldn't fill even if we raised, a few $100 million. So the process of running a Bitcoin mining operation really at least in the US and North America where we're dedicated, begins and ends with locating power and locating a community where you're going to be able to thrive. So I'm not going to share where we have our operations because that's not the way that's not Bitcoin, but that's really the beginning. It involves getting in touch with your source of energy generation, helping them understand what you want to do, and really, really spending a lot of time educating folks. The same kind of goes on the fundraising side. It was really important to us that our sources of capital deeply understood what we were going to be doing, because this is not a traditional business. So our banking relationship, we spent 6 to 9 months educating them on how this stuff works, what kind of business we are. We see our banking partner the same as we see our investors, and so we make really regular updates to them, really, really detailed. That level of transparency is important. And then that kind of brings you to the suite of expertise. You need to have a world-class electrical engineer. You need to have a world-class network engineer. You need to have world-class general contractors, electrical contractors. There's a really, what I think is incredible, physical construction component to this business. I spent my past in software and fintech. So for me, it's incredible to go somewhere, it looks like the jungle. You go back 2 weeks later, they've cleared all of the high grass and they've started to put down fill. You go back 2 weeks later, it's been graveled and they've poured concrete. You go back 2 weeks later, and the beginning of the bones of your structure are going up. So the being able to physically execute on the operation, building the space is one thing. Being able to execute on all of the energy is another thing. Being able to make sure that the machines are going to run, the way you expect, and then, in a secure fashion. We We spend a lot of time thinking about security, both physical and cyber. In the same way that, Bitcoin is exciting because it is a massive multidisciplinary field, Bitcoin mining is the same thing. It brings together a lot of different physical construction trades, and it also brings together a lot of computer science and network trades as well. So we see really the kind of four-legged stool as our energy relationship, our capital relationships, our physical infrastructure relationships and process, and our digital infrastructure relationships and process. And we need to execute on all four of those or we will fail. And then what sits behind all of that as well is the supply chain piece. Managing the ASIC market is a really, really complex and nuanced process. And it's something that, that we talk about as a team daily, if not every other day. We're monitoring those markets really closely and carefully as well.
That's insane insight into the entire process. I don't think people realize how difficult and multifaceted it is. And last question for you, Harry, is it getting more competitive? Like, is there a better class of Harry the competitor out there today than there was a year or 5 years ago?
Certainly than 5 years ago. I think that it's really interesting. The folks who come into the Bitcoin mining space are really at two ends of a spectrum. You've got your total speculator who says, Bitcoin price went from 3,000 to 10,000. Now it's time for me to jump into mining. And they're not terribly sophisticated. And, maybe they want to throw money at the problem. To folks who are thinking like that, just go buy Bitcoin. It's going to be easier. I promise. You'll probably make more. I know you'll make a lot more money. You'll spend a lot of time and headache trying to figure out the mining world. And you'll ultimately, potentially blow up. If you own Bitcoin, you're good. You'll see exposure to the asset class. At the other end of the barbell, they're really sophisticated folks. It's exciting for us to see, the Blockstreams of the world get involved. We know that they bring the best in class talent to the table, other than ourselves, of course. And so from their perspective as well, they see a future where there's some not altruistic mining, but there's some diversification mining. And this is a point I wanted to hit on, which is that, there is a point of view that if you're a large Bitcoin holder, or you're an institution with a large business line that relies on Bitcoin in some fashion, putting 1% to 5% of your cost structures towards mining is a way to hedge the future risk of this security. And if you may be able to make money this year, but you may lose money next year. And so, knowing that you've sized your risk appropriately within the business in a fashion that just really counts as one of your cost line items because you've got such a large related revenue line item being, your Bitcoin business or massive Bitcoin holdings. This is something I think we're going to see more of, so if you hold $1 billion worth of Bitcoin, it might be worth to just spend $10 million a year on mining or $5 million a year on mining, because in the long run, you're hedging the future risk of the security model by doing something like that.
Yeah, that's insane color. I couldn't agree more. And Nick, I didn't want to forget about the last point you brought up about Roy Sabag's Bitcoin dilemma. I thought it was super interesting. I'm going to let you take it from here on your thoughts there, because I definitely wanted to include it in the podcast.
Right. So I think something about the gold bug argument to Bitcoin that I'm having trouble resonating with is that it still doesn't eliminate trustlessness, right? Like, you can create a peg between gold and Bitcoin, but it's still not really digitally verifiable. It's kind of how we got ourselves into this whole thing in the first place, coming off the gold standard in the early 1970s, is because other countries no longer trusted the United States to provide accurate estimates of what they had vaulted in gold. So, I mean, that's just, do we have better ways to audit that are cheaper now compared to then? Yes, but it's still leaving up to chance incentives to misrepresent what is actually held. So I don't see a way around that aspect of physical versus digitally native. And you see things like, I mean, there really is, unfortunately, it's a little bit more anarchist than I like to go for crypto, but I think it's relevant because the motives that started the process resonate more with that, but there can't be too much trust placed there, right? So I think it's really all around that. And you can't do that with gold. And should there be a run on the bank or people want to cash in fiat for some gold peg, should think about the kind of situation that would prompt that kind of a bank run. You're not going to be able to do that, right? So, like I said, that is a little bit tinfoil hat, but ultimately, I don't think there is a way to eliminate that. And it makes Bitcoin a better collateral or a better neutral asset for trade than gold in that way. I think, and Dan Held's thread on the sustainability of Bitcoin security model, there was an interesting example of a transfer of gold between New York and Frankfurt. I think the market value of that gold at the time was $12 billion. Well, that transfer took 3 years and cost $4.8 million. So those are additional reasons why it makes more sense in terms of, in that case, you see what compared to other technologies, there's the gripe on speed and cost, but compared to the previously most trusted store of value, that's incomparable. That's an exponential gain when looking at Bitcoin versus gold. So I think it does revolve around that and this kind of proof of reserve concept where it's just infinitely less expensive to do that with Bitcoin. And again, given the kind of situation that would really prompt a hard shift into digitally native assets, it's going to take some time to let that slip away from something that is very, very clearly auditable, verifiable from a remote location.
Got it. Harry, any thoughts there?
Yeah, I mean, I think we were at the end of a very short aberration in history where national fiat is the be-all, end-all of money. That's not what we've seen historically, and it is in all likelihood not going to be what we see for the long-term future. It's just kind of a question of how we transition from here to there. I couldn't agree more with what Nick said about certainty. You know, this whole game is all about certainty. We see that in the 21 million supply hard cap. We see that in terms of social consensus. And the wool's been pulled over our collective eyes for so long, you know, with regard to the financialization of our day-to-day lives. You know, we don't understand that we took out a mortgage on our house. That mortgage was packaged up with who knows what else all over the country, chopped up, rated AAA, and we were told it'll never default. Well, it all defaulted. So, you know, so what are we doing? You know, continuing to go down that road again and again. And, you know, this time, the whole discussion around the increase in the price of the repo market recently, the evidence is all right in front of us. You know, and I'm hesitant to be such a tinfoil hat kind of person, but trusted third parties are security risks. And when that trusted third party, you know, is controlling your individual proof of work, AKA, you know, the savings that you've put into your 401k or your, God forbid, the pension you think you're getting, that proof of work that you've contributed 40 years of your life towards with no certainty whatsoever that those benefits that will exist or that the purchasing power that those benefits denominate will even exist is really, really crazy. And we're going to look back in 30, 40, 50 years on this period of time as a complete aberration. And those of us who got the smelling salts early enough will stand to greatly benefit. But I really do have an eye on how that transition gets managed because, you know, it could get scary and there could be a lot of pitchforks and torches.
One other quick thing, I'm sorry, that it all like the problem is not just with gold being hard to audit or verify a proof of reserve. That problem is not it in and of itself. It's how that trickles into many other things, like what we're seeing with a potential manipulation or price suppression scheme among your commercial banks who ultimately get paid in fiat. So they had that, how costly it was to verify the amount of gold in one vault or another, created ways to issue paper claims or derivatives on a supply of gold that became way blown out of proportion with what was actually there because of the cost. And then because of how costly it was, then the incentives are in place to suppress it in other ways. So it's not just that. There's a whole host of problems that stem out from that cost.
For sure. And, thinking ahead on this topic here, guys, how do you view the future, like dystopian view of the world where we only have Bitcoin? Like, I'm always wondering who's going to pay the firefighters and the cops. I personally don't think it's going to get to that point. I think of Bitcoin more as a hedge against it, where every senator and every congressman has to think about what they're doing to the economy because we have this plan B. How do you guys think about that world?
Well, I think actually I agree with what you said in that I don't think it becomes dystopian because this is here and built up enough before that problem happens, should it ever really burst all at once like that. I think that politics are going to have to take a look at solutions, and I don't think there's many better alternatives that are not completely inflating away the value of what has been promised to your policemen and firefighters, like you said.
That's helpful. Harry, what do you think?
Yeah, I mean, it comes down to being a very large-scale, complex incentive problem. The optimist in me thinks that we're headed towards, a Nash equilibrium being Bitcoin. So if China, Russia, and the U.S. all say, I want my currency to be fiat, nobody's willing to move an inch, everybody's next best solution is going to be the apolitical one, being Bitcoin. That assumes, rational game players, which we've seen, many times don't always behave that way. So I think that there's a non-zero chance of the most dystopian version of things. I think there's a much higher chance that we're able to manage that transition period because we do have the release valve. We do have this hedge that's out there. And I think that the sooner we see central banks take Bitcoin onto the balance sheet, the sooner that we see government involvement in mining operations, like we're seeing in Eastern Europe and elsewhere, the more rapidly that we see Bitcoin integrated into the larger global economy, the smoother the transition's going to be. So if any of the listeners are lobbyists or have a regulator's ear, I really, really encourage you, for the sake of our future selves, to make the case that this outcome is certainly non-zero and quite potentially likely.
Yeah.
Right. And I think the chance of the max dystopian case is kind of even mitigated by these kind of debt issues. That's really the overriding theme across all continents, because that issue exists fairly symmetrically, at least across the developed world. It makes that Bitcoin as a Nash equilibrium solution far more likely.
For sure. Guys, thanks so much for your time. It's always great to have normal discussions like these. I think they're awesome just because they're easy to follow and they're normal and really natural. So, Nick, Harry, thanks so much for your time. Can't wait to share this.
Thanks, Tom.
Thank you, Tom.
Hey, everyone. Thanks for listening to the episode. If you can go to iTunes and hit subscribe to the Chain Reaction Podcast, it'll go a long way in helping us reach new listeners and help support the show. Thanks again.